Today's guests are Zach Mangles and Khadidra Honeybrooks with WealthSpire Advisors. WealthSpire is an independent registered investment advisor with 20 offices in 12 states throughout the Northeast, Atlantic, Midwest, and the West Coast. They are fiduciary advisors who act as a wealth manager, investment advisor, consultant, constant partner in helping their clients gain confidence in their financial futures. For more information on WealthSpire Advisors, please visit www.wealthspire.com. I'd like to introduce our speakers now, Khadidra Honeybrooks. Khadidra serves as Senior Vice President, Director of Wealth Strategy, Wealth and Tax Planning. She is a key member of the Family Office Services team and works with ultra-high net worth clients and their advisors to identify complex estate, tax, and wealth transfer strategies. Khadidra began her career in-house at U.S. Trust, Bank of America Private Wealth Management in New York, where she advised ultra-high net worth clients on effective preservation and transfer of assets. She also worked at a small law firm in Napa, California, before joining Koblenz Patch Duffy & Bass, a high-end boutique in San Francisco, where she practiced for 5 years and was named to the Best Lawyers Ones to Watch list for trust and estate laws. Khadidra lives in her hometown of Oakland, California, with her spouse, Laura, a nonprofit executive, and 2-year-old daughter, Ruby. Our second speaker is Zach Mangles, Senior Vice President and Financial Advisor based in San Rafael. Zach combines his passion for helping people lead fulfilling lives with his skill for deftly managing finances based on individual goals and dreams. He believes that an advisor plays 2 important roles for a client: to provide context for their financial situation, which can be complex and challenging, especially in a busy world, and to act as a sounding board for major financial decisions. His role is to provide the data to keep clients focused on their objectives, acting as a layer between emotions and actions to help them make sound financial decisions. He specializes in planning for retirement, education, and estate. Zach has been with the firm since 2011. In addition to serving clients, he is also a member of WealthSpire Financial Planning Committee. Originally from the Los Angeles area, he has fully embraced Marin living with his wife, Haley, and 2 young children, Nora and Reed. Now over to you, Zach and Khadidra.
Thanks, Nikki.
Yeah, thanks, Nikki. We'll take it from here. Today, we're going to talk about estate planning in today's environment. On the agenda, we're going to talk about current and impending changes, estate interest rates and the estate tax exemption, and then we'll also talk about planning considerations and strategies given those changes. We'll talk about net worth, asset type, and interest rates. We're going to start off by talking about interest rates. We're all familiar in one way or another with the unprecedented rise that we've seen in interest rates over the last year. Most people, when they think about this, they're either thinking about, the fact that buying a house costs more, refinancing their mortgage costs more, or the fact that they're finally earning more money or earning more interest at the bank. But these higher rates also have an implication in the estate planning world, and we'll talk about how to navigate those changes throughout this talk today. Next, we're also going to talk about the changing estate tax exemption. And for that, I thought, Khadidra, we might start off by explaining what the estate tax is and who should be concerned about it.
Sure. So before we talk about the estate tax, let's talk about the estate tax exemption. So the exemption is the amount that you can transfer during your life or upon death without incurring a tax. And that exemption amount is currently pretty high. It's almost $13 million per person, or $26 million for a married couple. And so the estate tax is levied upon any amount that's over that exemption. So currently it's $13 million, $26 million for a married couple, but it's set to sunset at the end of 2025, beginning of 2026. And we think it's going to go back down to about $6 million per person, or $12 million for a married couple. And again, any dollar that's over that amount is going to be taxed at a rate of 40%.
All right, so we've talked about the 2 challenges in estate planning today, and that's this upcoming change to the exemption that Khadidra just mentioned coming down the road, and then the fact that, to prepare for that, if you're doing something today, we're in this higher rate environment. So Khadidra, what are the specific things that people should be thinking about when they're assessing whether or not they should engage in the estate planning today?
So that's going to depend on a couple of different things that we'll talk a little bit more about. And those are really what your net worth is, what types of assets you own, and the current interest rate environment. So in terms of net worth, we've kind of broken this down into three different categories. So you'll remember that the estate tax exemption amount right now is about $13 million per person. So if you're well above that, there are definitely some things that you might want to think about doing now. If you're in the $6 million to $13 million range, meaning you don't really have an estate tax problem today, but you will certainly have one if that amount sunsets, like we talked about in 2026, you also probably really want to pay attention because maybe there are some things you want to do now. There definitely will be some things that you'll want to do later. And then in the $0 to $6 million range, you might be thinking, well, even when the estate tax exemption goes down to $6 million, I'm still under that, so I'm never going to have an issue with estate taxes. That's not necessarily true. We know that if nothing happens, the estate tax exemption will go down to $6 million, but there are a lot of people who want that number to be even lower. So Democrats, typically speaking, want that exemption amount to be $3 million per person or maybe even $1 million per person. So what that means is that a lot of people would really be affected, especially if you live here in California and you own real estate here.
And what I'm taking away from all of what you're saying is really no matter where you are on this sliding scale of net worth, this is something that you should be thinking about today, starting to talk to your estate planning attorney, talking to your financial advisor if you have one about this upcoming change to the estate tax law.
That's right. So the next consideration we have is your asset type. So what do you own? There are a lot of specific strategies that clients can use for different types of assets. So if you have highly appreciated assets or assets that you think are going to appreciate, they have a high expectation of growth. There are certain planning strategies that we can take advantage of. If you own a large concentrated position in a certain stock, if you own a small business, or if you're a partner in a private equity or a hedge fund and you want to give some of those interests away.
And what sticks out to me as you read through these asset types, these are all really complex assets to have in your estate. And when you have complex assets, setting up an estate plan, putting the strategies in place, and actually getting them ready, that can take some time. And 2025 is going to be here really soon, or 2026 rather. And so, really, 2025 is the last time that we'll be able to start planning for the change. And I can tell you that the latter half of 2025, any estate planning, any quality estate planning attorney is going to be fully booked up working with their clients looking to make changes. So my point in saying this is if you have complex assets, the time to start thinking about it and planning is right now.
That's right. So the final consideration is interest rates. Now, Zach, you talked about the rates that clients normally think about when they hear interest rates, like mortgage rates or rates they're earning at the bank. There are some other interest rates that we think about as estate planning attorneys. The two main rates that we normally think about are the AFR, which is the applicable federal rate, and the 75/20 rate. So each month, the IRS publishes each of these rates. The AFR is the minimum interest rate that can be charged between related parties so that there's no gift. So think about a parent who maybe wants to loan money to their children. If you want to loan money to your kids, you don't really want them to have to pay you back tons of interest. Maybe you do, but typically from a wealth transfer perspective, you don't. And so you can set those loans at the AFR, which is lower than sort of the typical interest rate we might think about. And then the 75/20 rate is used to calculate certain payments that we're going to go over in just a minute. These rates are are both calculated based on the yields of certain government debt obligations. And since they are used in implementing different estate planning techniques, the effectiveness of the technique is really going to depend largely on where these rates fall.
And this graph here shows how these interest rates have changed basically over the last 20 years. You see the AFR, short, medium, and long plotted out, as well as the 75/20 rate. And I think kind of eyeballing it, it looks like it's averaged in the 2 or 3% range. But what you can see in more recent history is we just came out of a really low environment, and now we entered into a high rate environment. And I would expect that it's going to get possibly higher from here as well, maybe getting back to where we were in the early 2000s. And so because interest rates are top of mind right now, we're going to spend the rest of our time talking about how interest rates impact different estate planning strategies.
Before we dive into those specific strategies, I want to explain a concept that's called split interest. So, a split interest is essentially when a present beneficiary and a remainder beneficiary are different people. And the current interest, so the interest that the present beneficiary gets, and the future interest, which is what the remainder beneficiary gets, those are each valued, and that value is determined by the 75/20 rate. So here's sort of an illustration of a split interest. So as you can see, someone, typically the grantor, puts some asset into a trust. And during the term of that trust, which can be set number of years, or it can be the grantor's lifetime, someone gets the right to something from that trust. And then at the end of the term, the remainder goes to someone else. So in this picture, you can see that the grantor puts something into the trust and the grantor gets the right to something back. That's one of the structures, but there are some others that we're going to go through too. There are a number of different types of these split interest structures, and some of them work really well in lower interest rate environments. Some work really well in higher interest rate environments. So we're going to kind of go through what those look like. And these can get really technical, so I don't want you to worry too much about the specific numbers. Just try to think a little bit about the concepts and see what might resonate.
So we're going to start off by talking about the strategies that worked really well in the interest rate environment that we just came out of. And those are loans, grantor retained annuity trust or GRATs, and charitable lead trust or CLTs.
So the first strategy that Zach mentioned are loans. So these are beneficial in low rate environments, and think the first example would be an intra-family loan. So again, that was what we talked about a little bit earlier, where parents want to loan money to their kids. And again, from a wealth transfer perspective, you probably don't want your kids to pay too high of an interest rate. And so you can set that interest rate at the AFR, which we talked about. So when that AFR is low, then the interest payments your kids are paying you back for borrowing money from you is low. And again, from a transfer perspective, that's a pretty good thing. The other is a sale to a grantor trust. Now, we're not going to go too far into what a grantor trust is, but just think about the concept of I put something into a trust, and then in exchange, the trust gives me a promissory note back. So I've essentially sold something into a trust, and I'm getting a note payment back from the trust. Again, same as an intra-family loan, that interest rate that's set is the AFR. So the lower the interest rate, the lower the AFR, the lower the note payment that's coming back, and the lower the interest that's getting paid. So the next strategy that Zach mentioned is called a GRAT, or a grantor retained annuity trust. And the way this works is that the grantor puts assets into a trust and then gets a set annuity payment back for a set term. And that annuity payment is based, again, on the 75/20 rate. At the end of the term, any appreciation that's over that 75/20 rate goes to the beneficiaries, who are typically the grantor's kids. So again, because it's set by the 75/20 rate, we want that rate to be as low as possible so that appreciation over it goes to the grantor's kids without having to incur a gift tax.
All right, so let's do an example to really drive home this point. So in this case, you have $1 million that you fund into a GRAT, and you have an expectation that over a 2-year period, you'll get paid that $1 million back to you. Call it roughly $500,000 per year. And then at the end of that 2-year period, any amount that's left over in the trust will go to your children or any other beneficiary that you designate, free from tax. So that's how the setup works. But let's look at how that looks at a 0.8% rate environment. You have that $1 million. It roughly comes back to you, and then there's 65,000 that's left over in the trust that pass to your children free of any gift tax. When the rate is increased to 3.6%, instead of being able to transfer 65 grand, it decreases down to about 22,000 that can pass free from gift tax. And then once the rate raises sufficiently high, you're not actually able to transfer anything to your children or your other beneficiaries. And when that happens, we say that the GRAT has failed. You weren't able to achieve that purpose of shifting money to your beneficiaries free from gift tax.
So another strategy that works well in a lower rate environment is called a charitable lead trust, or a CLT. This is where the grantor puts something into a trust and a charity gets the right to something for that set term that we discussed earlier. So here the charity gets the right to an income stream. Then at the end of the term, the remainder beneficiaries, who are typically the grantor's kids, they get the remaining balance. So the value of that lead interest, what the charity is getting, that's calculated when the trust is funded, and it's based in part by that same 75/20 rate. And then the grantor can get an income tax deduction for that amount. So the lower the rate, the higher that first interest that the charity gets, which means the higher the income tax deduction.
So we'll bring this together again in another example with a charitable lead trust funded with $1 million. So this is going to be a 20-year term on this trust. During that 20-year term, the charity is receiving fixed annual payments of $50,000 per year, while the assets inside the trust are growing at 5% per year. At the end, anything that's left over in this trust will go to your children, and you, as the grantor of this charitable lead trust, are able to receive an upfront tax deduction. So again, we'll look at, in a low rate environment, you have the charitable beneficiary receiving $1 million. That's that 50,000 times 20. They receive that over the term of the trust. And then based on the assumptions in this, the growth rate of the assets, at the end of the trust term, your children will receive $1 million. And as a result of this entire transaction, you're also still getting a over $900,000 charitable deduction for yourself as well. When that raises to 7%, the charity still receives the same amount, your children still receive the same amount, but that charitable deduction has now gone from about $900,000 to about $500,000. One of the things that I really like about charitable lead trusts, or I think charitable trust really in general, is that it really works well for people who are charitably inclined and genuinely want to give money to charity. You get to put assets in a trust that will grow. The charity gets some amount of income or some funds that are sent out to them. Your children or your beneficiaries have the ability to inherit money as well. And then you're also getting a tax deduction on top of it. So it can be a win-win-win situation when this is done correctly. Next, we're going to talk about charitable or estate planning techniques that are more beneficial in the higher rate environment that we are entering into now. And those are QPERTs, or qualified personal residence trusts, and then charitable remainder trusts, or CRTs.
So the first example is a qualified personal residence trust, a QPERT, and this is where the grantor puts something into a trust, and that something is a residence. And then the thing that the grantor gets back, the right that the grantor gets back, is the right to occupy that residence, to live there for a set term. Then at the end of the term, the balance, which is the residence, is going to go to the beneficiaries. This is a particularly tricky concept, and there are definitely some property tax considerations. So you should really make sure to talk to a lawyer if you're going to walk through this one.
And so we'll look at an example again of $1 million house. In this case, you're transferring it into a QPERT that has a 10-year term. And over that 10-year term, your property appreciates at 5%, so that at the end of 10 years, what was $1 million is now worth 1.6. In a low rate environment, you've transferred this $1.6 million to your children. And as a result, you've had to report a gift of about $630,000. In a higher rate environment, that same property is still transferred to them, but the gift that you're reporting is only about $350,000.
And so the final concept with the higher rate environment is the charitable remainder trust, or CRT. So a charitable remainder trust is where the grantor puts something into a trust, and then the grantor typically receives a right to the income for a set term. Then at the end of the term, the remainder goes to charity. So again, that remainder interest is calculated as of the funding of the trust based on that 75/20 rate, and the grantor will get potentially an income tax deduction as well. So an additional wrinkle here is that the value that goes to the charity at the end, it's valued at the beginning of the trust, and that value has to be at least 10% of the total trust. So the higher the 75/20 rate, the higher the remainder interest, which means the higher the income tax deduction, and also the more likely that that the remainder interest is going to be at least 10%.
And so we'll look at an example here again of $1 million that's funded into a 20-year CRT. You, as the grantor, are receiving a fixed annual payment of $50,000 per year over the 20 years. Meanwhile, the assets inside the trust are growing at 5%. And then, as Khadidra said, at the end of the term, anything that remains in the trust goes to charity. And then, of course, you, as the grantor, for setting up this CRT, get an upfront income tax deduction. So we'll take a look in a low interest rate environment. You fund the $1 million, and the charitable beneficiary gets $1 million at the end of the term. You are, of course, receiving your $1 million payment, and then although the charitable beneficiary received $1 million, the value of that remainder interest was calculated below that 10% amount that Khadidra was talking about. And so as a result, in the way that we've constructed this example, there is no income tax deduction that you get. Using this same trust setup in a 7% rate environment, you actually would get a income tax deduction to the tune of about $470,000. So clearly, we can see that in a higher rate environment, you as the grantor, the charities as the ultimate beneficiaries receive the same amount. What's changing here is the size of the income tax deduction, and clearly having a larger income tax deduction is going to be better than a lower one. The last thing that we'll talk about are strategies that aren't really impacted by changes in the estate tax rate or the estate tax regime that we're in now.
Right. So basically, anytime you're making just a straight gift, the interest rate doesn't really matter. So especially when we're talking about clients who are going to have a taxable estate, so they're going to be subject to an estate tax, we want to think about potentially using up your gift tax exemption and making gifts, but not giving away so much that you have nothing to live off. So there's always sort of a look at cash flow, lifestyle calculation as well. But some of the gifts that we often see are gifts of qualified small business stock, or QSBS. We also see gifts to grantor trusts. You'll remember earlier we talked about sales to grantor trusts, which work really well in low interest rate environments, but gifts to grantor trusts really can work anytime. Also, a straight gift of a private equity interest or an interest in a hedge fund, we can do some pretty interesting techniques with those, and those pretty much work anytime regardless of interest rates.
And then 3 other of the more commonly used gifting techniques are the annual exclusion, which is any person's ability to gift $17,000 $70,000 this year. That increases every year with inflation. But you're able to give $17,000 to any person that you want, free from gift tax. So it's an exclusion from gift tax. Related to that is the EdMed exclusion, which is the ability to gift to an educational institution or a medical institution on behalf of somebody, and not create any gift tax liability as a result. And then the final one, which most everybody is familiar with, is the fact that gifting money to charity results in a charitable donation and income tax deduction for yourself. So all of these things, these are gifts in various ways, are things that are not dependent on changes to the estate tax environment, or sorry, the income tax interest rate environment. There we go. And really are usable at any point.
So this is just a summary of some of the strategies that we went over. You can see there are some in the low interest rate environment, some in the high interest rate environment, and some that work well in both. So again, we talked about different considerations. This is all within the context of the estate tax exemption potentially changing at the end of 2025. So it's really important to pay attention to it and to think about how these different interest rate environments might impact which type of strategy or strategies you might want to use. One thing we want to add to is that all of these are very complex. So it's really important to talk to your individual attorney about these. We are not practicing law here. So if you have future questions or you want to implement any of these, please do make sure to talk to a practicing estate planning attorney.
And the last thing that I always want to bring up anytime I'm talking about estate planning, it's kind of a separate topic from what we're talking about, but it's that it is always important, it's always crucial to keep your estate plan updated. I have often seen clients or talk to prospective clients who are 95% of the way through executing their estate plan, and it's that last 5% that's really holding them back. And what I say in that case is it's better to have something in place that gets a majority of your wishes set in stone than continuing to have an estate plan that doesn't meet your needs and wishes. And then the last thing, of course, is the importance of working with a financial advisor. Your financial advisor sits at the nexus of partnering with you to look at your entire financial life, all of your financial circumstances. So when you're thinking about things like the upcoming change to the estate tax exemption, or the fact that we're in a higher interest rate regime now, it's really helpful to be talking to a financial advisor who can help you determine what strategies make sense for you both now and in the future. And that is all we have today. We wanted to thank you for joining in to our presentation, and we hope to talk to you soon.
Thanks so much.
Thank you for listening to this event sponsored by WealthSpire Advisors. Please visit wealthspire.com for more information.